Good morning, guys. Here we're going to be doing shares and dividends. Shares represents what we issue in order for us to raise capital. Basically, shares are simply a portion of ownership that we give people. In return, they give us money. Us by us, I mean as the company. Okay, they give us capital. They give us our capital, and we give them shares, of which gives them the right to certain benefits that the company has. Right. In return, we as the company are going to give them a return which we refer to as dividends. Dividends is simply a return calculated as a percentage of shares that each shareholder has in the company. It's just a percentage of shares issued to whoever bought shares from the company. Okay, and we'll just be doing the intro part of it, and we'll get into it in detail when we get to grade 12. Okay. Now, definitions. What are shares? Shares is simply a portion of ownership of a company and is divided into shares. A company issues shares in order to raise capital. So basically, in order for us to get money that we can use to buy certain things that will enable the company to run smoothly. All right. The founders of a company may issue shares or ownership interest in order to raise the required capital. So the company will issue shares in order to raise the required capital. Founders of the company are simply the originators or people that started the company, all right? And obviously, those people will want to get more money in order to run the company. Remember, the bigger the company gets, the more money you will need to run that company. And I told you that getting a loan must always be the last option. So capital is the first thing that you're gonna come up with that you will consider when you want to raise capital for the company. Okay. Remember, every business needs money in order to operate. I've explained that. A person that buys shares from a company is called a shareholder. A person that buys shares from the company is called a shareholder, which makes complete sense. A shareholder simply means people or a person that holds shares, a holder of shares. Shareholders, a holder of shares. A person that holds more than 50% shares in a company is called a majority shareholder, and such a person has control over the company. So basically, they can make major decisions for the company. For you to make proper voting rights to control the company, you need to at least own 50% plus one. All right, 50% won't give you that much power, but 50% plus one will simply give you a lot of power because you can decide on major things that needs to be done in the company. Your voice will be heard more; it will be louder than other people's voices. Remember, shares give you a voting right, and so basically if you have a voting right that is 50% plus, it means your decisions will matter. The founders of a company are simply people who establish the company. The first number of shares issued to the public are called initial public offer. I hope you guys have heard of IPOs. We refer to them as IPO, initial public offer. The difference between a public and a private company, we will discuss that in detail when we get to grade 12. When a company buys shares from the company, when a person buys shares from the company, they receive a share certificate which has details about the number of shares that the person owns in the company. So basically, that's all you get as a shareholder. You just get a paper which tells you how many shares you own in the company. However, you have paid for that share certificate, and the payment, we call it share capital. And I will show you shortly how we calculate share capital. Since a person pays for these shares reflected in the share certificate, the company will receive their money. So we give them shares, and in return, as the company, we receive their money. Basically, the shareholders has shares and the company has money. They have shares shareholders have shares, we have the money. What is the difference between authorized and issued shares? There's a different class of shares that we will only focus, but we will only focus on ordinary shares, which give the holder ownership interest in the company. Authorized shares are simply the maximum number of shares that the company may issue, and this is reflected in the company's memorandum of incorporation, a contract which is a contract between the shareholders and all the shareholders, the stakeholders of a company, describing how the company should be run. All right, so basically, we may not issue shares that are more than authorized, and obviously, authorized shares will be authorized and it will be in the memorandum of incorporation. What are issued shares? Issued shares are the shares that we took from authorized and we sold them to whoever decided to buy them, and those people we normally call them the shareholders. Note that issued shares may not be greater than authorized shares, as authorized shares represents the maximum number of shares that the company may issue. Like for instance, if you have 5,000 rand, you cannot buy an item worth 6,000 rand, because it means that you will not have enough money. Okay, let's say credit wasn't available, you will not have enough money. So in this case, that's what I'm trying to say, is you may not issue what you don't have. Authorized is just the maximum number of shares, so basically you cannot issue more than authorized shares. Please note that even though authorized shares the number of authorized shares, it's reflected in the memorandum of incorporation, it may be changed later by the shareholders. All right, but for now, just remember that I think will be done when you do your first year or second year, I'm not sure, but for now, just focus on the fact that your issued shares, you may not issue shares that you don't have, you may not issue shares that are more than your authorized shares. Now, what is an issue price and share capital? Issue price, or what we refer to as the share price, is simply the selling price of each share. That is the price at which the company is willing to sell each share for. All right, and the share issue price is determined by demand and supply of shares. Note that the higher the demand, the demand, the lower the price. The lower the price, the higher the demand. However, you need to understand, if demand goes up, it drives prices up, which is weird. Okay, but people will demand. The more people demand your shares, it will drive their share price up, because it sends a positive signal to the market that your company is doing well, it's growing. People want companies that are growing, that are doing well, so that they can be able to get a return, which is dividends, when they invest in that company. Everyone wants to be a winner. The only reason you will want to buy shares from another company, from a company as a matter of fact, is to have some sort of a return, and your return will be guaranteed as long as the company keeps on growing, it keeps on expanding repeatedly. All right, if your company is surrounded by scandals, the share price obviously will be lower. People will not be interested in buying shares from your company, and it'll be difficult for you to raise capital. I'll need you to follow Steinhoff, news about Steinhoff, where one of the directors was involved in corruption, and later on Steinhoff wanted to raise money by issuing shares, but people were not just buying shares; they were not coming to buy shares from Steinhoff. And obviously the share price was way too low, because they wanted to attract people to come and buy shares, but that didn't work. Okay. Share capital is simply the number of shares that we have issued. You multiply them by the issue price, which is the share price. Okay, that is very important. This is the formula that we're going to be using to calculate the money that we're going to be receiving from the shareholders. Please, here's an example. When the company authorized a share capital of 5 million as stated in its memorandum of incorporation, the company's financial year end is the 28th and 29th of February 20, or the 29th of February 20. It can be any other year. I don't know why I'm putting in 20s there. On the 1st of March 2017, the company issued 2 million shares at 2 rand per share. Please note that 2 million will be the number of shares that we have issued. 2 rand will simply be the share price. For us to get share capital, the money that we received from the shareholders, we're going to multiply that 2 million with 2 rand. So hence we get a share capital of 4 million. 4 million will be recorded in the CRJ. It is money received by the company. And when we record it in the CRJ, we're gonna have the name details will be shareholders, analysis of receipts will be 4 million, bank will be 4 million, and sundry accounts will be 4 million. The account that is affected will be what we refer to as ordinary share capital. Just like any other capital account, ordinary share capital will increase on the credit side. It's basically what we have. We owe that amount to the shareholders, even though the shareholders are not our liabilities. But you'll realize that both your liabilities and anything that we get from the shareholders, they increase on the credit side. Okay, so hence that ordinary share capital, it's simply capital. It will increase on the credit side, and you will cast that. You will get your total value. Your bank is an asset. It increases on the debit side, it decreases on the credit side. Your bank will increase by the amount of money that you received, which is 4 million rand. So basically in the next month, which is the 1st of April, we will be having 4 million rand, which we got from our shareholders when they invested in the company. Note, money is coming in. That is why bank increases on the debit side. Note that the company has money and the shareholders have shares. And then we've got ordinary share capital. What is ordinary share capital? Share capital is a contribution by the owner, so it will increase owner's equity on the credit side, it decreases on the debit side. Please note that it will increase by the issue price and it will also decrease by the average issue price, which we normally refer to as the average price per share. This account will increase on the credit side as I have specified. We have bank CRJ 4 million and we have issued 4 million. Actually, we have issued 2 million shares and we raised 4 million. Please note the following: contribution by owners increases owners' equity. Owners' equity will increase on the credit side by the share capital amount, and hence our balance carried down that will carry to the 1st of April will simply be that 4 million rand. This is the money that we received from the shareholders. Okay, remember, owners of a company are called the shareholders. This is a very important note. It is what we refer to as ordinary share capital note. It starts with authorized shares. You need to state how many shares were authorized. The number of shares authorized is 5 million, and then you'll have issued shares. How many shares did we issue? And you also need to specify the share price and when those shares were issued. So you will simply say 2 million shares, additional shares were issued at 2 rand during the year, and that gave you a share capital of 4 million rand. So at the end of the year, we'll have a share capital of 4 million rand, and the number of shares issued will be 2 million rand. Okay. Example number 2, a company has authorized shares and we have a balance at the beginning of the year, which is 2 million shares, which gave us share capital of 4 million, but we issued more shares, which is 800,000 shares, additional shares at 400 cents per share. No entry was made with respect to this transaction, which tells us that this ordinary share capital balance that we have from the extract trial balance, extracted trial pre-adjustment trial balance, will simply be an opening balance. It will not be our closing balance. How do we record this? Note that we're going to record the number of shares, actually the amount that we received, which is 3,200,000 rand. I will show you shortly how we got the 3,200,000 rand. I simply took the 4 million and I multiplied it by 400 cents divided by 100. So whenever you see cents, you must just remember 400 cents simply means 400%, or you can just say 400 divided by 100 and you will get the value, which will give us that 3,200,000 rand. So for November, that's how much we will have received. Please note that your cash receipt journal, your journals and your general ledger, your journals are prepared daily and your general ledger is prepared monthly. All right, general ledger is prepared monthly and your journals are prepared daily. Now in this case, balance brought down, we had 4 million, but that 4 million increased on the 1st of November. That's why I put in the 1st of November. I don't put in the beginning of the year. It's because our bank account will be prepared monthly. Okay, on the 1st of November, I will still have that 4 million rand. provided that nothing happened, we didn't receive any money or we didn't pay anything. Okay, our 4 million rand will be that on the we will have a balance of 4 million rand on the 1st of November. However, on the 30th, we actually had more money and we issued more shares, and that is from the issue of more shares, which is 3,200,000 added with 4 million. So in our bank account now we have 7,200,000. So we're gonna bring it forward to the following month, which is December. We will have 7,200,000. I've explained that. Our ordinary share capital will increase on the credit side. Our ordinary share capital was 4 million. It's no longer 4 million now. It is we add 3,200,000. It is now 7,200,000, and that is why in this case our balance carried down for the 1st of December will be 7,200,000. Let's move to our share capital note. Our ordinary share capital note will have authorized. Number of shares will be 5 million, but we issued additional shares, which was 800,000 shares at 400 cents, and that's how we got that 3,200,000. But I just want to notify you of something. At the beginning of the year, we had shares that were already issued, and it was 2 million shares, and the share capital on those shares was simply 4 million. So at the end of the year, you're going to take this 2 million and add it with 800,000. It means we have issued 2,800,000 shares. Please note that they don't exceed authorized, and we're going to have 4 million share capital. You're going to add it with 3,200,000. Our share capital will now be 7,200,000. Now let's do the buyback of shares. What is this buyback of shares? So far we've been focusing on the issue of shares. The buyback of shares, it's when we buy back, the company buys back the shares it previously issued. So we're getting our shares back and we're returning money back to the shareholders. All right, the company will have to pay for those shares. That is a cash outflow. At the end, the company will have its shares back and the shareholders will have their money back. Okay, it simply means that for the company to buy back shares, it must have enough cash. You can't buy shares using loans, because loans, guys, have disadvantages. You have to pay them back with interest. And when people find out that you bought shares back using loans, you simply tell them that you don't have money. And remember, you can't pay shareholders on dividends on credit. You need money to pay back your shareholders. So you need to have money for you to be able to buy back shares. Only willing shareholders will be interested to sell their shares back to the company. And note that shareholders will only be willing to sell shares back to the company if they're getting an amount higher than what they initially paid for those shares. Meaning that we as the company will buy back shares at a price higher than the average price that a shareholder paid for those shares. Because shares were issued at different prices, we're going to be using average price as the original issue price, as the original price that each shareholder paid for each share they bought from the company. Statistically, the average amount is always a best estimate of the original cost. Okay, reasons for the buyback. Why will the company buy back shares? The company may have a lot of unutilized retained income and may want to reward its shareholders. But remember, it's your choice as a shareholder whether you want to be rewarded or not, because you will be reluctant to sell shares. When you sell your shares, you're losing control over the company. You're losing your returns in the future will be reduced. Right? You're losing your say in what happens and what you want to happen to the company. And so basically you won't have it, so you're losing your voice, you're losing your voting rights, and you wouldn't want to do that. You remember, the buyback is an indication that the company has enough money. Why would you want to sell your shares as a shareholder back to the company when the company is making more money? That's why a company needs to pay you a higher amount, an amount higher than what you initially paid. Okay, or the heir may not want a shareholder may have died and the heir may not want to be a shareholder. As a result, will want to sell shares to the company. So basically, that's one of the reasons why the company will buy back shares. Basically, it's like a shareholder, a heir of a shareholder doesn't want those shares and they just want to get rid of them. So you as the company will have to buy back those shares. The company may believe that its share price has been undervalued by the market. The buyback will increase the market price of its shares as it indicates to the market that the company has a positive cash flow. It makes the company look financially attractive. So when you buy back shares, you're saying, I'm ready to reward my shareholders. I'm returning money back to the shareholders. It means you have enough reserves, you have enough money, and you don't know what to do with it. And basically, you will also want to reduce your future dividends, the amount that you will pay as dividends. Remember, as a dividend is simply returned to the shareholders. It's simply a percentage of shares that were already issued to the shareholders. So it indicates, it sends a positive signal that the company is growing, that the company has enough profits, that the company has enough money, and it will result in share price going up as people will have a positive perspective about the company, about the growth of the company, about the cash position of the company. The company may want to improve its financial indicators. This is a fourth reason as to why the company will want to buy back shares. Financial indicators that I gave you as examples here is simply EPS and DPS. EPS is earnings per share and DPS is dividends per share. For you to get EPS, you will have to take your earnings, divide them by the number of shares issued. Note that when you buy back shares, you reduce the number of shares that were issued. So basically, the denominator of your EPS will be lower. If the denominator is lower, it means your EPS will be going up, which is earnings per share. It tells you that each shareholder will be earning a higher amount per share that they bought from their company. Basically, it will increase that if you buy back shares from the shareholders. Return, it will simply boost your statement of financial position. To reduce shareholder ownership interest, a company may think that it has a lot of shareholders and it may want to get rid of them, because the more people you have, the more shareholders you have, the more difficult it becomes for you to make decisions. Please note, more people make it more difficult for you to make a decision. If there's only two of you, it's easy to make a decision. But if there's a lot of you, it's very difficult for you to make a decision because you need to consult each and everyone. So you may want your shareholders, number of shareholders, to be reduced and to make it easier for you as a company to make decisions. Remember, shareholders do make decisions for the company. In a way, they are the owners of the company. To improve the company's statement of financial position, remember, when you buy back shares, it will reduce dividends, and when you reduce dividends, your earnings will be higher, which boosts your statement of financial position. Now, financial indicators that must be met before and after the buyback. It's a solvency ratio and the liquidity ratio. Solvency refers to ability of the company to repay all its liabilities, more specifically, its long-term liabilities. Liquidity ratios refers to a company's ability to pay short-term debts. That's why you may not get a loan to buy back shares, because it'll affect your liquidity and solvency. So you must be solvent before you buy back shares, and you must also be liquid before you buy back shares. Remember, as a shareholder, ordinary shareholder, you are actually, your investments are a bit riskier because you only get whatever remains after everybody has been paid, after creditors have been paid, after all the lenders have been paid. That's why they say liquidity, because liquidity refers to the lenders, people that you owe money. We must first be able to pay those people, either the short-term people, people that we owe for the short term, or people that we owe in the long term that we have to repay over the long term. Those people must be certain that they will get the money first before we can start returning money back to the shareholders. Okay, remember, as a shareholder, you are like a pilot of the plane. The plane is your company. You go down with the plane. All right, everyone can leave, they can have parachutes, but you as a pilot, you go down with the plane. You can only leave that plane once everybody has left the plane. All right, meaning that you're the last man standing, so you will only reap the benefits of whatever remains. That's why it's riskier for you to be a shareholder. The older you are, I will discourage you not to be a shareholder. Rather, invest in tax-free investment. The younger you are capable of taking more risk. That's why you need to be buying shares as young people. It's actually very risky. The higher the risk, the higher the return. That's how the market works. Okay, the company must have enough cash and retain income for it to buy back shares. Using loans to buy back shares will impact the company negatively, as loans must be repaid with interest and weakens the company's statement of financial position. Okay. These two indicators must be met before and after the share buyback. However, I need to emphasize that only condition one is required to be met as per the Companies Act. Okay, now what is the average price per share? Average price per share, because we have issued shares at different prices, we have lost the original share price. For us to get the original share price of shares that we issued, we're going to estimate it by using the share capital before the buyback. Remember, shares are issued at different prices over the company's duration, over the company's life. So basically, because we have issued shares at different prices, it's hard for us to track what the cost price of each share was. The cost price of each share is simply your share price. Okay, we don't know what it was, so we're gonna estimate it by calculating our average price per share. I call it APPS. You will get this by taking your share capital before the buyback, you divide it by the number of shares issued before the buyback. I repeat, share capital, which is the rand value, divided by the number of shares that were issued. Profit or loss from the buyback. You will have a profit from the buyback if your average price, which is the original price of shares, is greater than the share buyback, which is what the company has paid to buy those shares. Let's say a shareholder bought the shares, which is the average price. What the shareholder paid will be average price, and the average price is 10 rand, but we buy them back at 8 rand. It means that the shareholder is making a loss and we are making a profit of 2 rand because we are giving the shareholder 8 rand per share, of which they paid 10 rand for. All right. And a loss will simply be where our average price per share is less than the share price. So basically, we buy back shares at 15 rand, but the shareholder only paid 10 rand for those shares. So we are making the loss, but the shareholder is making a profit. If the shareholder is making a profit from the buyback, it means the company is making a loss. Guys, these two definitions are very important. Please go through them, rewind until you get them right. Okay. Now, here is a question here. The following information relates to Greystone Limited. Authorized share capital is 700,000 shares. Extract of balances and totals of adjustments have been made. So at the beginning of the year, which is the 1st of March 2017, we had 5,848 as share capital. Now, share capital. Let's read about share capital. It says on the 1st of March 2017, 70% of authorized share capital was issued. What is our authorized share capital? Our authorized share capital is 700,000. So you're going to take 700,000 and multiply by 70%, which will give you, I think, 1,400,000. No, it's actually 490,000. It's 490,000. 7 times 7 is 49. It's 490,000. So this share capital is made up of 490,000 shares that were already issued on the 1st of March. Remember, this is share capital on the 1st of March. These are the number of shares that were in issue when on the 1st of March. 70% of 700,000 will be 490,000. On the 1st of November 2017, we issued more shares, 160,000 shares at 11 rand 51. So basically, we're getting more capital from the shareholders. So basically, for us to get share capital, you're gonna take 160,000 rand and multiply it by 11 rand 51 cents. On the 29th of Feb, though, which is couple of days, which is 10 days or can be 9 days before the financial year end, we bought back shares, 50,000 shares from the estate of G. Gallagher. It was decided to offer purchase at 16 rand per share. The offer was accepted by the estate of G. Gallagher and the money was paid from the bank account of the company. So we are buying these shares back at 16 rand. Question is, how much did the shareholders pay for these shares? For us to figure out how much the shareholders paid for these shares, we need to find what we refer to as the average price per share. Now, we're going to be preparing our ordinary share capital note. Nothing changes. We're going to have authorized shares. The number of authorized shares will simply be 5 million. And then we're going to have issued shares. At the beginning of the year, we had 70% of authorized shares issued, which is 490, and we're going to have 490 shares issued at the beginning of the year, which is the 1st of March 2017, and it'll give us our share capital of 5,848,000. And then we issued more shares, 160,000 shares during the year at 11 rand 51 cents, and that will give us 1,841,600. However, something happened later on the 19th of Feb. We bought back shares. Buying back shares, it means those shares will no longer be issued. They will now be part of your authorized shares. Okay, they will form part of your authorized shares. They will be moved from being issued shares. Now these shares were bought back at, here remember I said these shares were bought back at the purchase. They were bought back at that amount. The amount that comes here can't be what we paid. It must be what the shareholders paid for these shares. How much did the shareholders pay for 50,000 shares? Now, for us to figure out how much the shareholders paid for 50,000 shares, I said price that the shareholders paid, the share price of these shares, the original share price, the amount that the shareholders paid will be estimated by this amount by calculating your average price per share. For us to estimate the original issue price of these shares, we're going to calculate APPS, which is average price per share. And obviously, for us to calculate average price per share, all I took this 5 million, which is share capital at the beginning of the year, added with this 1,841,600, which is the share capital. Remember, in the numerator, you'll have share capital. This is before the buyback. Share capital before the buyback divided by the number of shares issued before the buyback. Before the buyback, we had 490 issued at the beginning of the year, and then we issued 160,000 rand during the year. 60,000 shares during the year. It means that the total number of shares issued will be 490 plus 160, which will give us the average price per share of 11 rand 83 cents, and that is the amount that we're going to put there as the average price, as the buyback price. So basically, your share capital will increase at original price and it will decrease at original price. Even though we don't have the original price of these shares that we bought back, this is the best estimate of the original share price, and we will multiply the two. The amount that you get, which is 591,500, you will put it in brackets. When you calculate your average price per share, please remember to always round it off to 2 decimal places. I repeat, when you calculate average price per share, please remember to round it off to 2 decimal places. And in this case, you will have 490 plus 160 minus 50,000 will give you 600,000. Those are the shares that we're going to have at the end of the year, which is the 28th of February 2018. Our share capital on the 28th of February 2018 will be made up of 5,848,000 plus 1,841,000, but you minus 591,500, it'll give you a share capital of 7,098,100. Now let's quickly calculate profit or loss. Here I was just showing you that the average price per share from the buyback and the average price per share at the end of the financial year will be the same. For me to get this 11.83 that is in green, I took this 7,098,100 and I divided it by 600,000, and I got the same average price that I got when I calculated the average price of shares that were bought back. This is because the last transaction was the buyback. If the last transaction is not the buyback, this will not apply. There are questions where I'm just going to give you this and I will require you to calculate that. Okay, Please bear this in mind because it's important. I'm going to show you guys how I calculate my profit or loss from the buyback. I normally start with my share capital, which is my account that was affected. Share capital will only increase or decrease at original price. In this case, the original price of shares bought back is 11 rand 83 cents. We're going to multiply that by the number of shares that were bought back. The number of shares that were bought back will simply be 50,000, and you're going to multiply that by 11,83. It'll give you a value, original price of the shares that were bought back. This amount will be recorded in the balance sheet and it reduces your ordinary share capital. All right, and then we're gonna have our bank is simply the amount we paid for the shares. We paid 16 rands for those shares per share. Okay, how many shares were bought back? We bought back 50,000 rand. So you're going to say 16 times 50,000 rand is going to give you 800,000. You put it in brackets because it's an outflow of cash. It tells you that money is decreasing. And this will be recorded in the balance sheet and it will reduce your bank account. It will also be recorded under financing activities in the cash flow statement, which will be an outflow of cash from the repurchase of shares. Another account, so from the buyback, only three accounts will be affected. It is the share capital will be affected at original price, bank will be affected at the buyback price. The last account will be retained income. Retained income tells us whether, as the company, you're looking at it from the company's perspective. As the company, have we made a loss or have we made a profit? Please note, I said APPS represents what the shareholders paid for the shares. These shareholders, for 50,000 shares, they paid 591,500, which is just 11 rand 83 cents per share. But to buy back the same number of shares, 50,000 shares, we paid 16 rand. So we paid shareholders 800,000 rand. We only received 591,000 rand, 591,500. I mean 591,000 rand 500, and we paid them 800,000 rand. So we made a loss. We overpaid, and guys, we overpaid by 4 rand 17 cents, which is a loss, and this loss will be recorded in retained income, which is 208,500. It will reduce your retained income. Please wait until we have done the retained income. Note, for your next exercise, please do prepare your this working because I need it for your next exercise, which is classwork 3. Now, that decreases your ordinary share capital, this decreases your bank account, and that decreases your retained income. It will increase your retained income if it is a profit, but in this case, it is a loss. So it will decrease. It will not increase, but it will decrease your retained income because it is not a profit, it is a loss. Okay? Please do classwork 3.